Welcome to part 2 of Income Tax Update for Landlords and Real Estate Investors. So let's talk about activities. And what do I mean by activities? Well, all real estate transactions are not the same. You could be a dealer in real estate. Who's a dealer? I'm a developer. I build houses. I sell them. I'm a dealer. I don't get to take long-term capital gains on those houses. Those are inventory. I don't get to deduct my cost of building a house till I sell the houses, as I would in any other inventory business. I flip houses. Well, is it a trader business or am I an investor? And the answer is it depends. If I derive all of my income from flipping houses, if I'm flipping 2 or 3 houses a year, I'm probably a dealer and not entitled to capital gains and need to be treated as a dealer, even if I temporarily rent some of those properties, especially if that's where I get the majority of my income. On the other hand, if I work for a company, I'm an IT guy or an IT person, and I work for a company and I get most of my income comes from a salary, and I flip one house every now and then because I like remodeling, then I'm probably an investor. I'm buying those homes as an investment. I'm fixing them up and selling them to make a long-term gain on the property. And whether I rent them, I might rent them short-term till the market gets better, do something. That doesn't change the fact that I'm an investor. If I built that whole development and I'm renting those properties out, but I'm only renting them out temporarily until the market gets better or I can find a buyer, that doesn't change me from a dealer to an investor. Most people operating rental property are investors. And as an investor, they get to take their deductions right away and write off the property and depreciation. Dealers do not get depreciation. Dealers also do not get the benefit of long-term capital gains. So the kind of records you keep, what you do, how much time you spend, all these things can lead to the decision. And we have seen decisions where the IRS has come after people and said, listen, you don't have any other source of income. You flip several houses a year. You've been doing it every year. That's where you spend your time. And you're saying that because you held this house for a year, it's a long-term capital gain and it's not subject to Social Security tax, self-employment tax. You're in the business of buying, fixing up, and selling properties. You're a dealer, and the gains are subject to Social Security tax. The gains are not available as long-term, regardless of how long you held the property, because you're acting more as a dealer than you are as an investor, holding properties long-term for profit or holding properties to receive rental income. So say dealers, it's all ordinary income. There's no capital gain or Section 1031 recapture, which only makes the capital gain a little more taxable, but not nearly what we have to do with ordinary income. If you're a dealer, you can't do an installment sale and delay the tax over the time you collect the money. If you're an investor, you've rented the property, you can sell it to one of the people you rented to and have them pay you. You can carry back the mortgage and have them pay you and pay the tax over the time that you're collecting the money instead of all the tax up front. But if you're a dealer, sell the property, give me some money down and some money a month for the next 60 months. You're going to pay all the tax when the sale is over, whether you collect the money or not. So it can be a very important distinction. Selling expenses of being a dealer are business deductions, the commissions, the advertising the properties, even if I don't get the property sold and I have advertising and marketing, those are ordinary business expenses. If I'm an investor, those expenses increase my cost basis and reduce my tax on the gain. So how things are allocated, this is a really important distinction. It doesn't happen often that an investor gets nailed for being a dealer, but you do need to understand it based on what your activities are. We've kind of gone through that. If you are a dealer, you're going to report your income on Schedule C as self-employment. IRS likes Schedule C because in addition to income tax, they get Social Security self-employment tax in addition to the income tax. So you're liable for the Social Security, and you get to pay both sides being a sole proprietor / self-employed. 14.13%, even if at the end of the day, you don't have enough profit to outweigh your standard deduction, doesn't matter. Whatever the net profit is, as a dealer, you're going to pay Social Security, Medicare tax on, and you're going to pay income tax on it based on how much taxable income you have. If you're a qualified joint venture held by a spouse, you might be a Schedule C and have to split the tax. You might be a Schedule E. Schedule E is for rental properties, and both of these can have qualified joint ventures. They both can have QBID business deduction, which can reduce taxes, but a Schedule E, you don't have any Social Security self-employment tax. The bad news is on Schedule E, for most of us, if your income is too high or if your loss is too high, you can, based on if your income is under 150,000, you're limited. You can take a loss. You can take some of a loss up to typically $25,000 in losses against other income. But if you're on a Schedule C, whatever your losses are this year, you can take those losses. You may even now be able to carry the losses back and get refunds from other years. Some important distinctions, something that most people aren't aware of and that you should be thinking about. Other business activities that could throw this one way or another is a lot of people are starting to rent Airbnb and through other sites short-term vacation rentals. Well, if your rentals are all short-term and you provide substantial services. Now, IRS has looked at that. If you do housekeeping, if you change my sheets and make my bed every day, you're really a hotel or some kind of lodging, and you are not a residential rental property, and you need to be on Schedule C. If the only time you clean up or change the sheets or do any other major services is after I leave and vacate the property. So I rent your property for a week. I get to use your towels and your pillowcases, but you don't make any beds or come in and clean the property until after I vacate the property. Then you're probably still a rental property. But this can be affected by these short-term rentals and the amount of services that you are providing. So I know a lot of people, at least until the recent COVID deal, who were buying properties and they were using them on Airbnb and a number of other of these short-term rental sites. And we had to talk about, what are you providing? Oh, I rent a room in my house and it includes breakfast and it includes, well, great. Those are substantial other services. You're making the bed every day, clean towels every day. We're no longer a rental property. That's a business activity, and we've got to treat it as such. Just be careful with these and make sure you understand and you keep the records you need to show what it is you're providing, and also, hint, hint, the amount of time that you're spending in the particular activity. Record keeping has become more and more important. We need it to support the QBID deduction that we take. We need it to support, when we have a rental property, material participation, so that we can take the up to $25,000 in losses depending on our income. Record keeping and how much time you spend and what you do to run this activity has become more and more important. Some states like Florida, if it's a short-term rental, charge things like we charge sales tax and bed tax. In some cases, the Airbnb of the world collects that tax and pays it over for you. And in some cases, they don't. But the fact that you fail to charge it to your customer does not mean you're not liable for that tax should the state or the local taxing authority come after you. So it's important to understand that. In Florida, if you have a lease that is less than 6 months and 1 day, you're liable for both the sales tax and the bed tax. If your lease is 6 months and 1 day, you don't have to collect the sales tax or the bed tax. And even if your tenant moves out a month into the lease and they don't stay 6 months and 1 day, because you have a written lease that they were supposed to, you don't have a liability for that tax. Written leases can sometimes be important to landlords, even though you might not chase somebody down, because they can protect you against sales tax. Okay, let's see. We've talked about Airbnb, and I've covered a lot of this, but it's going to be in the slides. Okay, just remember, substantial services can convert you, And those can include anything from housekeeping to concierge services, to arranging tours and outings, to providing any kind of meals, entertainment, or transportation. So you provide a van, or you going to the airport and picking somebody up that's renting one of your properties. That could move you from the residential rental Schedule E to the hotel category. And it's all about facts and circumstances, folks. So I get a lot of calls now on rental income. There has been in a number of places these eviction moratoriums, which they should have probably listed and said, instead of eviction moratorium, this is excuse for renter not to pay, because I've heard from many of my clients about renters that are not paying rent because they can't be evicted, even though they're still going to their job every day, even though they're still getting paid, even though they got money from the government. That money didn't come to the landlord, and the landlords are kind of stuck with these people. They can't evict them. Well, if you've got somebody living in a property, when they get 3 months behind, they're probably never going to get caught up, and you're never going to get your money. And when they do allow us to evict these people, we're going to be able to evict them, but we're not going to recover 6-8 months worth of money that we've been unable to collect. And you're going to find that even if they wanted to, now that they have to pay, if they didn't have the money and used it for something else when they were living in your property because you couldn't evict them, they're not going to be able to come up with the money when the eviction moratorium is over. So unless there is payments from the government that are direct to landlords that work something like Section 8, unless there is some reason for you to get the money from somebody that's subsidizing them, whether it's, some other outside agency that's helping them get caught up, we're probably going to see a lot of evictions and a lot of people leaving. And the people that are calling me want to know, do I get to deduct that rent I didn't collect? And the simple answer is no, you don't. Most of us are cash basis taxpayers. That means we only report the income we actually receive, the rental income that we receive and are paid when we receive the money. And you are not going to get to deduct for money that you never showed in your income. You didn't get the money, it never showed up in income. It will reduce your taxable income. It may create a loss for you, but you don't get to go in then and deduct what's owed to you and that you're unable to collect as a bad debt. So you're not going to get a deduction per se, but it is going to reduce your income. So if they were supposed to pay $1,000 a month and they didn't pay you for 6 months, instead of $12,000 worth of income for this year, you're only going to have $6,000 worth of income. And if next year, it should happen, they come up with the $6,000 they're behind and write you a check, then next year, assuming the rent stays the same, $1,000 a month, you're going to have $18,000 worth of income that you collected that you have to report on and then pay tax on. Or stuff that counts in your taxable income is the rent you actually collect, including any advanced rent. You require your tenant to pay you the last month's rent in advance. That last month's rent is income to you in the year they paid it to you, not the year that they stay for the last month. Non-refundable charges. I charge a pet fee because you're moving in with pets. Charge the fee up front. You're never going to get it back. That is income to me. I charge a rekeying fee. You're never going to get it back. Any kind of charges that I charge and collect up front, including late fees that I collect along the way. Fair market value of any barter. So my tenant says to me, listen, I don't have the rent this month, but you need the oil changed on your car. I'll change the oil and I'll tune your car up in exchange for my rent. Well, if your car isn't a business deduction, that's great. You don't have a deduction for what the car costs are, but you do have income. You have to show what those services are worth. If the value of the tune-up is $300, then you receive $300, and even though you didn't have the cash, you're going to have to include that under rent as barter transactions. This can happen for all sorts of things. My wife grew up on a farm, and farmer says, gee, I'm going to supply you vegetables and you're not going to charge me for my tax return, then I would have barter income for the value of the vegetables. Things that you need to look at: barter income is taxable based on its fair market value. What would have been the cost of buying that product that you got or that service that you got? What does it trade for in the market? Common area maintenance fees. If you have a CAM on your property, we have commercial property, we have a CAM fee, we figure out what the common area maintenance fees. That's part of our rent that we collect. We deduct those expenses. They show up on the bottom of our tax return under expenses, but we have to, the income we get from our tenants to offset that CAM fee, that is taxable income. It's rental income to us. As a commercial property, we have tenants that get assessed for the value of the real estate taxes. Whatever our tax bill is, they pay a percentage of it every year. That real estate tax that they're paying to us is really rent. It's an adjustment in their rent. We deduct the real estate taxes. That is a tax we pay and an expense to us. Our tenants give us rent to offset that cost and expense, even though the invoice to them says pro rata share of taxes, of real estate taxes. Non-income things like refundable security deposits. I require you to give me a security deposit. If you move out and there's nothing other than regular wear and tear, I'm going to refund it to you. I would not count that in my income because that's not my money. I'm just holding it as security. Refundable pet deposits would work the same way. That's somebody else's money I'm holding. I only take it into income if I don't have to give it back because the pet did damage, and then I deduct the expense of the damage. We've reached the end of part 2, but we have much more information coming in part 3, beginning with rental expenses and how to make sure you don't miss any deductions. So stay tuned.